Yes, no, maybe. Okay, great. Thanks, guys. All right, so where were we? Supposed to read that. All right. Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders are discussed are tracked, monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not the service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your result may vary. By accessing this webinar, you agree to hold the above harmless from any losses you may incur as a result of the information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone. All right, there's that out of the way. So, what's going on? So far, we had a nice little pop today, and I was just saying to people how it's a good time to short. So why don't we do that right away? We find the, who was it that was good to short? Oh, the S&P. So we find the S&P. We like them short at 1960. We missed it by a little bit, but that's okay. We'll just short one here just to get on the ball. And there, I've got my little bell sound, so we're okay. I have the speaker turned down because I was talking to somebody yesterday on the thing. Let me get a little louder in case we do it again. Okay. So now ideally I want it to be short at 1960, so I might add a couple here. The S&P ones are very small movers, so I'm not too worried about it. The dollar is moving up. It's bouncing off the support line, so hopefully it goes higher and puts a little bit of pressure on the indexes and makes a couple of bucks. So that's the S&P futures index. It came up and just because it goes over the line doesn't mean it's bullish. I mean, well, usually you're going to go to a line and maybe test it a little bit. But if you don't get some bit of a real move below it where it starts acting on the opposite way, support or resistance, it's still a valid line. So in other words, here you went over, but there's no resistance coming back down. It came right back down. Here you went over, not much resistance, and boom, broke down again. So it's not acting like support yet. It's still kind of a resistance line. If it consolidates here and starts going higher and then it tests it and then it goes up again, that's when it starts turning into something like support. Like this line is kind of looking like over here for the Russell. So I'm less inclined to short the Russell, but if you look at the other charts, the S&P is still right up at the top and the Russell is curled over and the NASDAQ hit resistance up here at 43.50 and the Dow hit resistance at 16,450. Oh, and there's 1960, so let's add another one. Let's see if we can actually get this. Should put in right here. Oh, that was easy. All right, so now my average is 1959.50. If I want to add one, I'd want to add one at 1960.50. And we'll see what happens. Now, you don't do this in absence of anything. I mean, you got to be looking at the news at the same time to see if it changed, if anything happened. But the main thing I care about right now is the dollar, because these little jitters in the dollar can have an effect. Although, look, the dollar ran up while the market ran up. So really, that's unusual too. Because usually if the dollar goes up, it puts more pressure on the market. Oddly, the dollar moving up didn't affect anything. Gold went up anyway. The oil went up anyway while the dollar was going up. Gold stayed pretty much flat. Silver stayed pretty much flat. And the indexes went up. So not typically what you get when the dollar makes a move like that, which is up from 95.30 to 95.80. That's a half a point. That's a pretty strong move on the dollar, and no reaction from the market. Now, maybe the reaction is delayed, maybe it's not. Now, see, just this morning I was talking about using TLT and shorting it, and see how it's crashing out now? Because it was silly. It shouldn't have been up that high. So, you know, in this morning's post, whoops, there it is. So in this morning's post, what did I say about TLT? Oh, there. I don't think bonds are as safe as cash. In fact, the bond ETF TLT probably still makes a good short at 121.58 because there are still too many people buying 20-year notes for 265 who think it's a good idea to lend the government money at that rate. You know, so basically, it doesn't make any sense. If something doesn't make any sense, that's the basis for the start of a trade, right? If you see something that makes no sense, that's a good thing to probably look at to say maybe I can make a trade there. It didn't make sense coming to a Fed meeting where they might tighten, and even if they don't tighten, I don't think they will tomorrow, but even if they don't tighten, they're almost certainly going to say we're going to tighten on a certain time, probably next meeting. Either one of those things can't be good for TLT, certainly not enough to support it at somewhere near these ridiculous highs. You know, don't forget, I mean, you're lending the U.S. government money, and TLT tracks a 20-year note. You're lending the government money for 20 years, and all they're going to pay you is 2.6% interest. That is ridiculous. They're going to use your money for 20 years, and each year out of $100,000, they're going to pay you $2,600. And you don't have your $100,000. And 20 years later, you'll have gotten $52,000 back. But so what? And then you get your $100,000 back. What do you really think your $100,000 is going to be worth by the time they give it back to you 20 years from now? You know, what if you think about how you would have gotten $100,000 together 20 years ago? You wouldn't, because $100,000 was worth like double, triple now. It's a totally different world now. And 20 years from now, that thing could be worth like $10,000. It's net loss overall. It's a crazy, crazy sort of proposition that the government puts out there. And that's where the real danger is. It's not the Fed raising rates. It's the Fed no longer supporting, oops, here's another chance to add on ES. It's the Fed no longer supporting this idiocy in the bond market. All right, so I'm going to sell one more, hopefully, and get filled. I need to see if I fill. I need to sell two at 196.50 to bring my average back to 1960. So that's kind of what we're going for here. I'm only selling one at the moment, though, so I want to see what happens. So we really, really took off right here, like at 10 o'clock. We just shot up like crazy. And it wasn't, I mean, all we had was business inventories. I guess they didn't have a very big build, but it wasn't really a data point that should have shot the market up. So it's just, you know, mechanical nonsense manipulating the market, basically. And I certainly wouldn't put a lot of stock into it. And of course, you know, when money comes out of the stock market, it goes into the bonds, usually, but that's not what's happening now. So go back to active trader. No, back to short, sorry. And I'll take a look. And I want to see when this stops, because this may be people may be selling bonds and buying into the stocks also at the same time, because it all kind of happened here. And that could be a positive thing. Those, you know, people could have said, "Oh my God, look how good stocks are compared to bonds. Let's start buying more stock." Who knows? But meanwhile, we're up almost 1%. We're up 1% on the Dow. We're up just under 1% on the Nasdaq and the S&P. We're up 1% on the Nikkei. I think 1% is plenty ahead of the Fed. I think that's a pretty long way to go. So I'm not. Oh, damn it! Hang on. Okay. Sorry, change in plan. Now watch. Now we came back to 196.50, right? And I'm short, but I'm going to now, even especially if I can buy it here. Oh, filled right away. Look at that. Okay. So what happened? I did put a buy in, but it didn't fill. Then we came back to 1959.50. That was my average because I bought the other one when it went up. You know, when it went up. So I bought my first one at 1959.25. Then it went up to 75, and I averaged 195.950. And this is where people get very confused trading the futures, because if you're scaling in, you have to remember to scale out as well. So I started with 1. That's my 1x position. Okay? I went to 2x, but the only reason you go to 2x is to lower your basis. But it doesn't make any sense to lower your basis if you get back to your basis and you don't. Why is that ringing? It's not supposed to ring. What the heck? All right. Anyway, I don't even know what that is. That's an automated call I get from the bond market floor to tell me that you got to watch out for the bonds. A little bit late. The trade's already been made. All right, so where was I? Right. So the whole point of going into the trade and to lower your basis is to have a lower basis. But what's the point of having a lower basis if you don't cash out back when you're even? You get back to the 1x position because now I've already raised my basis. Now what? So now I can sell again at 196.050 if it fills. Now I brought my average up to 196.25. Well, okay. So now my average is up to 196.025 or 196.0, I would think. So now I'm too short at a much higher entry than I started out at. And of course, while I'm doing this, nothing changed. None of my premises changed. The market's moving up a little bit more, but not for any particular reason that I can see that makes any sense. So I'm going to be happy to stick with my short for now. And I'm going to expect to see a little bit of a pullback. I mean, and also I'm going to keep in mind that my pullback line, see, the Dow's not going to go that low. It's only going to go about 50 points down, which is nothing. The Russell also has support over here at 1150, and it's only at 1153. So I'm not expecting a big pullback. I'll be through with 195.750. That would be a nice pullback for me. Meanwhile, it's going the other way. So we'll see. Now, you don't just double down either. I'm very comfortable with too short on the S&P. If we go all the way up here, well, if we go all the way up here and I still think it's a nonsense move for whatever reason, then I'd be inclined to get another one up here. But it's not my first choice. I don't really want to. If I get 2 more here, my average short would be 196.708, which sounds great when you're at 1960, but I don't really want to ride out because I would have a loss of 2 at 15 times 20. Like I still have a loss of like $300 or something at that point. So I'm not looking for that to happen. Ideally, I'd like to keep this. I was hoping it would stay under 1960, and I want to see how perky everybody is right now. See how they kind of stop falling? So right when I get that call warning me that the bond market, that the bonds are selling off, they stop falling. Like a real contrarian indicator, that thing. That's a service, too. You actually pay for that. It's called a Mortgage Market Guide. That's my baseline experience in real estate. I still have it. So let's see. I still have it because it's useful. It's nice to get a little message on my answering machine and stuff when there's a big change in the bond market. You know, even if it's better for people who don't pay attention all day, like realtors. It's for somebody who's trading. It's useless because it's so late. And it's not their fault. It is their fault, but I mean, it's just the nature of the service. They've got an automated dialing machine. It has to call 100,000, 200,000, whatever people. It takes time. So you're just not going to find out the second it happens. The only way to find out the second it happens is keep your eye on TLT and see what's going on. All right, so where are we? Let's see if there's any questions that might be useful. Nope, wrong one. Here we go. Still the wrong one? Wait, what am I doing? Oh, no, chat. Here we go. Hi, guys. And Tao Zhang says, can you explain for Butterfly Portfolio why buy 20 Walmart 17 puts and calls and sell 2016 puts and calls? Okay, he's talking about, we just went over in member chat at Phil Stockwell, we went over the Butterfly Portfolio. Where would that be? That would be here in our chat. And, that reminds me, I do have some stuff I want to talk about too. That's the 5% portfolio. We'll get back to that later. Butterfly Portfolio, here you go. Okay. So we have this Walmart position. And we have the January. These are going to expire soon, right? So they're useless. We have the January 2016. We have the 8750 calls. This is an old position from 2014. We have the 8750 calls, which are now way too high. and we have the 70 puts, which came in actually in the money. What we paid for them originally was net of $6.45, and here's a good example of why I love this portfolio. We paid $6.45, right, for this position. We now have $7 of value, so we never lost a penny. Now that these puts are in the money, we actually are getting all of our money back a year later and more from this trade. You know, we're going to come out with a small profit. Well, here's the profit. In fact, we lost $2,000 on this one. We made $27.50 on that one. So we're making $600. So the long position is completely free. It didn't even have to be paid for by the short puts and calls that we sell on a regular basis. It's just completely free. And if you look at Walmart as a stock, even though it sold off pretty sharply recently, it generally, we started here when it was high, and all these sales, we got sales in here, we got away with most of these. We adjusted down at one point, but then it had this steep decline and we got caught. So we're down a few bucks on the shorts that we sell. All right, so what was my strategy? Because we don't like to be down. Being down is not fun. So we currently we don't owe obviously the short caller any money because we're way below that. We sold the $70 calls on 820, and already, not even a month later, this thing is down to 64 bucks. That's terrible. But we sold the $70 calls on 820, and those are, of course, worthless. We sold the $70 puts for $2. Now, here's one point, though. We collected $3, or $2.90. We collected $2.90 for these puts and calls. We now owe $5.75. So we're only down $2. It's really not like a big deal. And this is only 1 month that we have a failure. So we're down net $2. But rather, but I don't like to be down anything. I don't like to take any money out of my pocket if I can avoid it. So meanwhile, though, these are expiring. So since Walmart is now at a low point where I think it could recover, where's Walmart? Don't I have that FinBiz thing? Monday, Tuesday, positions, closure. I'm missing something. Anyway, all right. I know, up here this is going to be short. Here you go, Walmart. So, as you can see, we've been falling in Walmart, and now we're down to $65. It went all the way down to $61.50 on the 24th, but, that was a crashy day, and we didn't pay attention to that. So I think really $63.50 $62.50 seems to be a nice solid floor around here. 65, and look, most importantly, Walmart. They've got $200 billion market cap. They have a PE of 13. Okay? Walmart sells $500 billion worth of stuff. That's a lot of stuff. They sell $500 billion worth of stuff, and they make $16 billion selling it. Okay? I don't care if they're not growing. They make $16 billion on my $200 million investment, billion-dollar investment. So if I give Walmart $200 billion, damn it, clear. So Walmart gives me back $16 billion against my $200 million, and that's 8%. Okay? They return 8% of my money in profits every year. That's without them increasing in value. This is something people don't really get about stocks sometimes. Is if you buy, you have to think of it as if it's a real company. Don't think of it as an abstract stock. Think of it as an actual company. Okay, Walmart is a company. I put my money into Walmart and I own it. I paid $200 billion to buy Walmart. Now this year Walmart makes $16 billion. That's 8% of how much I put into the company. They're either going to reinvest it in the company, or they're going to distribute it back to the shareholders. It doesn't disappear. It never disappears. Or they'll keep it in cash, and it adds value to the company. In fact, if you look on the balance sheet, They've got $9 billion in cash sitting around. They've got $45 billion in inventory sitting around. They've got virtually no debt. They've got $45 billion in debt, which I guess you'd say is something, but for somebody that size, it's 10% debt is nothing. They got very little debt. They've got all their property, equipment, so on and so forth. They've got, I can't even tell you how many stores. It's a lot of stores. See if this thing tells you. They've got 11,000 stores in 27 countries. These are assets. It's not nothing. They've got huge, huge assets. And they also make 8% every year. If I put my money in the bank, or if I put my money in a U.S. bond, which is 2.6%, but let's say a U.S. bond paid me 8%, there's no asset. The only asset is the $100,000 they're promising to give me back. So that's my $100,000 in the first place. With Walmart, I'm getting 8%, and I own all these assets. It's a real thing. In theory, that asset can appreciate over time. Because also part of the operation is a bonus in addition to the profits here. They're also running the company and building stores, and those don't show up as profits, but as they expand and grow their operation, you get something out of that. Now, the funny thing is, though, that's totally obvious to an Amazon investor. And that's the whole point of Amazon, right? They're going to grow, and that one day they'll decide to make profits, and they can just flip a switch and make money, right? That sounds great. But meanwhile, Amazon, that looks pretty shocking, right? Amazon sells $88 billion a year, and they lose money. Or, well, let's call it even. They break even on $88 billion a year. They can flip all the switches they want to, and they're not going to drop $16 billion to the bottom line. All right, whereas Walmart can flip one switch and go online, which they already are online, actually, but they don't do it very well. But they're working on it. But Walmart can flip one switch and basically be a full competitor to Amazon. They've got all the distribution in place. They've got all the vendor agreements. They've got all the merchandise. They want for nothing to give you the absolute experience that Amazon gives you, except for they really are just stuck in, they have their mindset as retail and Amazon's mindset is not retail, and both of them need to get somewhere in the middle to make the consumers happy. Also, Walmart doesn't do the membership thing. If it wasn't for Prime memberships, Amazon wouldn't make a penny. Amazon Prime is like $80 a year, $100 a year, something like that. And they've got millions of Prime members, maybe 10 million, 20 million. That's 10 million at $100 a year is $1 billion. If it wasn't, so figure they got 20 million memberships at least of Prime, and in Amazon, and that's $2 billion a year. Just as Prime memberships. If it wasn't for that bonus $2 billion that they were collecting, they would be negative $2 billion. All right, but Amazon, meanwhile, with their $88 billion in sales and no profit, have a market cap of $200 billion. Walmart has a market cap, I'm sorry, let's look at the exact number here. Amazon has a market cap of $250 billion. Let's put it that way. Walmart has a market cap, it's like a joke. Walmart has a market cap of $200 billion. Amazon is worth, in theory, 25% more than Walmart, even though they've got, I don't know, 80 into 56 is what, 6? They've got 1/6 the sales. And not even, I mean, you can't even compare it. I mean, you can't even possibly say they have no profit. They're $16 billion short in profit. So either, and they're both true, either Amazon is ridiculously overvalued, ridiculously to a factor of 10 overvalued, or Walmart is ridiculously undervalued, probably to a factor of like at least 50%. So Walmart should be trading somewhere with a PE around under 20, I would say 18, 17, something like that. But either way, significantly higher than we are now, about 20, 25%. So Walmart should be around $75, $80 easy. All right, so that's the point of Walmart. And And somebody asked earlier today, they said, well, how do you pick a stock for the portfolio? I look for stocks that are volatile month to month, but end up in a pretty predictable range. Okay, so what is Walmart? Walmart is very up and down on a monthly basis, all over the place, and even a quarterly basis. But over the long term, this line will true out. They'll come back up here. So this line will true out over time. So you're never going to get totally burned in Walmart. They're not going to go to 50, and they're not going to go to 100, because 100 is ridiculous, and so is 50. But 75, just right. And you can play that year after year after year after year for them to come back around that area. So, meanwhile, since they are low in the channel, the move we're making is to take, well, we're just cashing this. This is just dead. I mean, it doesn't matter. We're taking our profit here and whatever. So now we're starting a brand new Walmart position from scratch. Unfortunately, 2018s aren't out yet. But what we're taking is we're picking up the 2017 20, 2017 65, 77, 50 bull call spread. So we're giving ourselves a 12.50 spread. Let's take a look at that on a thing. Okay. The way you enter that is you just go to the 65 very simply, and you say you want to buy a vertical, and it says which. It assumes you want to buy the closest one, but we don't. We want to buy the 72.50s, and you can just change it. Whoops. There. So wait, not 72.50, 77.50. What did I say? 77.50. Get myself confused. I'm like, that didn't look far enough. 77.50. Now I feel better. So you want to buy this bull call spread. The prices we saw, well, first of all, you can see them right here. This isn't 510. That's the last sale. This is 525 to 550. So at the moment, I sure wouldn't pay. Where's my price? Oh, it doesn't give you individual prices if you do it this way. Sorry. But anyway, so you say this is between 525 and 550. Let's call this 535. Or 540. Let's pay the extra nickel and say 540. How much are the 77.50s? They're 170, and that's about fair, between 142 and 190. So how much is what did I say? 540? 540 minus 170 is 470, 370. And here you go. It's even telling me it's 370. And how much was it when we looked at it before? The net was, it's 525. So it hasn't really changed. It's basically the same as it was before. So we're buying 20 of those. All right. The short puts, which we owe money on, we owe $665 on those. We're going to just roll those along to the January 65 puts. Now, why January? Was that the actual question? I didn't know what the question was anymore. Let's see what the actual question was. Why buy 20 long but only sell 10 shorts? Oh, that's easy. That's just because we're bullish on Walmart. Can you explain the butterfly? Why buy 20 and only sell 10 of the puts and calls? Yeah, okay. Because I'm bullish on Walmart. So all I want to do is pay off the cost. You know, we already sold these September 70 puts. So here's your September 70 puts, and they're 552. Oh, because Walmart went up, so that's why everything's getting cheaper. So these are 552. So we have to work off our 552. And I look ahead and I say, well, where can I roll this to? And there's no way good to roll it, because you see, I owe 552. So here's the 67.50s, and I have to pay $1 to be in those. So I say, you know what? Here's what I'm going to do. I'm going to go to January 65 puts, which is, were they the 65s? I forget. Yeah, so it's on the January 65 puts, because I think this is a good floor for the reasons we just discussed. I think that's a good floor. So we're going to sell the 65 puts for $375, and we're going to sell the 67.50 calls here for 180. But the problem is I'm bullish on Walmart, so I sure don't want to go to a full cover. So in case Walmart goes lower, I've got plenty of room to roll these to a lower strike and double them down, if I have to. So I can easily get out of trouble on these because I only sold half. And on these, I can also easily get out of trouble. Now, the other thing you have to realize on this trade, though, is I don't need to sell a lot because I cashed $7,000 here. I got all my money. That's very unusual, by the way, on a butterfly. I'm not supposed to get all my money back. We just lucked out. But I got all of my money back plus a bonus like $700, $800 for the bull call spread from last year. So I'm just taking that money and I'm only using, I'm using the same money and I'm reinvesting it into another year of a long. All right, but I don't care whether this makes money or not. This is all free to me. So all I care about making money is here. And what am I doing with my free money? I'm selling $3,750 plus $1,800 is $4,000, $5,500. I'm collecting $5,500. That is a very good portion of this $7,000, isn't it? And I'm collecting that in just one quarter, and I got 4 more quarters to sell after that. So the answer is being conservative. I don't know if Walmart's going to suddenly pop back. I don't think so, but if it does, that would hurt. And I don't know if it's going to fall further if the whole market collapses. But either way, selling only 10 keeps us flexible, and selling only 10 for one thing. Look at this. We only have to sell 10 to get $5,500 a quarter. So if I get $5,500 this quarter, which is quarter 4 of this year, and I've got 4 more quarters next year to do, I could collect $25,000 against my $7,000 outlay. And that's $18,000 I have to play with in between here and there. Now, $18,000 divided by 10 positions is $18, and that means Walmart could go up or down $18, and I'm not going to really lose money. So I have $18 of leeway. Now, meanwhile, I am covered with the 65.75, so I'm covered to the upside that I don't expect that, unless they go over 77.50 here, I'm not going to lose any money there. So it would have to go 18 above 77.50 before I start losing money. It would have to go below 18 here, so down to like $56, no, not 56, $46 before we lose money there. But essentially, if it goes to $46, I really don't mind owning Walmart flat out for that kind of price. So I have very little worries. We can easily roll to a 2 times position down the road if we're wrong. But if we're not wrong, we're either going to be wrong and we're going to double down and have a bigger position like you'd like to have probably, or we'll be right and we'll make $25,000. Either way, I think that's a good outcome. Now, if I start with 20, then I better be right, because if we're wrong, we're going to start losing quite a lot of money. So what would you rather have? Would you rather have a circumstance where if you're wrong, you don't care, and if you're right, you make money, or would you rather have a circumstance where you can make a lot of money if you're right, but you also might lose some money if you're wrong? I prefer to pick the scenarios where there's almost no way you can lose. If you keep making trades that almost can't lose, they'll add up. Trust me. Over time, they add up. In fact, look at the portfolio. It's up 75%. So yeah, it adds up over time. It's slow and it takes a while to build, but once this thing starts going, look at this. We're gonna, if we happen to look out on this trade, we make $5,000 again this month. This is brand new $5,000 money. And on the other one, which was the other one that we made a big move on? On OIH, we did something similar. Here we went to 2018. We put $5,000 in our pocket, and we sold another, $4,500 worth of calls. That's on one position in 1 month. That's not 1 month. Sorry, it's January again. So I'm starting to use the quarters, and we're rolling this to January. So in 1 quarter, those $5,000 on this one, $5,000 on that one. After a while, it adds up to something, right? You don't get too bored doing this. It's supposed to be boring, though. This is a butterfly portfolio. This is literally for old people who want to play once a month. That's what this portfolio is for. You make your trades, you set it up, you go away, you go on a cruise ship, you don't think about the markets, it doesn't really matter, and you'll just deal with whatever when you get back. That's how this portfolio works. And it's my favorite. I love it. I wish I could get people more interested in it, but people are just so bored by it. It's just, there's nothing to discuss. We don't talk about it. We don't do anything with it. It's nothing. It's an ignorable portfolio. God bless it. All right. Let's see. Who else we got here? Okay. Pop. Oh, no. Don't tell me that. What? Did I miss something? Ah. No! Okay, now, here's the situation in which you do want to add. I missed my chance to get out. I got to look at where we are. We're over here, so we're hitting resistance here, but the S&P is far from its resistance. How are the other indexes looking? Oh, good. So the Dow's hitting resistance. The S&P is lagging to the upside now, unfortunately. The NASDAQ is not hitting resistance yet, but the Russell's hitting resistance. So I want to see if these guys pull back. If they don't, I'm going to have to wait. But if these guys start getting rejected here, then hopefully I can start looking for a short over here. But at the moment, we're blown out on that position. That sucks. See what happens when you don't pay attention. So we're down $625. Ouch. So again, it's too early to add because I don't know if it's going to stop here. I don't want to have 4 positions short and go up to here. Here I have confidence shorting. Here I don't. So what am I saying though? I'm saying I'd rather be down $1,200 and then double down than double down when I'm down $600. Because if I double down here, I'm only going to move my position from 1960 to 1963. That's not really exciting. So, you know, now that I got burned, I'd rather see this. But now I got to look at the S&P seriously and think about what's going on. So ignoring the other guys, let's just take a quick look at the S&P. I tell you, these seminars are real expensive when I do this because I'm not paying attention. Futures. All right. So we're going to look at the indexes. And we're going to go to well, there's a daily view. That's useful. See, the NASDAQ is popping. See this line over here? They're coming up over a long-term resistance. So is the Russell. The S&P can still go quite a bit higher before it hits any resistance. And the Dow also still has a bit higher they can go. So not good from a bearish standpoint. For whatever reason, things are moving up. Now, I immediately say, well, what could I do to offset this problem? I look at the Nikkei. What the hell? Where is this happening?
My baby. The news. I just went out for one.
Oh, it's got to be Yahoo. They suck. They are so annoying with their commercials. Yeah, it was Yahoo. Where was it was so distracting. All right. So, meanwhile, I'm going to look for, like, what do I do in case this keeps going up? Who's the lagger? Not the lagger, not the lagger, not the lagger, but look at the Nikkei. He's lagging. He's only at 18.2. Okay? So now I'm going to say, oh, wait a minute. It's the Nikkei. Look, and the dollar's strong. That's good for the Nikkei. So the hell with oil or gasoline. And let's go NKD. It's already up at 18.225. But let's add a couple of these just in case things really pop. I think the Nikkei is good for quite a few points. So let's buy one here. Buy 2 here. So now I do have something bullish. And if it goes under 18.2, I'm going to get out of that with a loss. But if it keeps going up, I assume if the S&P keeps going up, the Nikkei is going to keep going up, and I'm going to make some money on that side. Meanwhile, so now that I have an offsetting bullish play, though, I'm more inclined to add a bearish play. Balance. It's always about balance, right? So now if I'm wrong and everything keeps going up, I am covered with my Nikkeis. Well, I wish I would have thought of that here, because that would have been nice money. That was 8 o'clock this morning. And what I'm trying to do is think about where would I want to plant my flag on this one. So now we go back to FinViz. We look at the S&P specifically, and we look at it hourly, and we say, where's the resistance? Well, clearly, there was see here, sharp rejection here, but they kind of passed that now. Rejected here, past that, so that's not good. That is not good for my bearish premise. Here they went up to here. So now I'm watching these peaks up here, and up here. That's 1980. I really don't want to see 1980. So now I know that if we get past 1970, I'm going to stop out. I'm not going to risk this. I would rather get out and get back in than ride this thing up all the way. But I am going to I am going to see what happens over here at 1970. Now the Nikkei on the same time frame hourly. See, the Nikkei's got a clean shot up to like 18.4, 18.350 or whatever that is. So the Nikkei's got very, very little resistance to move up, and it's already lagging our indexes. And our indexes are now what? What's on our machine? Our indexes are up like 1.2% basically. All right, so the Nikkei got a good start much before we did, and it's been lagging since. So I'm hoping at this point, I'd like to see the Nikkei go higher. That'll fund my losses on the S&P so I can take a deeper stance. Ideally, though, I want to short at 1970 if we get that high. You see here I made $50, and here I'm now down $700. So now they're keeping even with each other. But I don't like this trade. It doesn't mean I didn't want to be long on the Nikkei. I'm just being long on the Nikkei defensively as it was lagging the other indexes. Here we go, 68. And 69 I would add 1. So why don't we just put that in since I can't watch it the whole time. So I'll put into sell 1. That way the bell will alert us if we want to sell 1 at 69. And you see how glad I am now that I went back to 1x before, because otherwise we'd be in big trouble here, right? So I put in my sale at 69, and immediately it drops to 67, so that's not going to happen. Not immediately, anyway. Now, if these guys start falling apart, see how he's having trouble with this line? And the dollar over there. What else can I look at? Let's not look at the dollar. Let's ignore that for now. Let's look at the Dow. Dollar. Now, the fact that when you're watching an index like this, the fact that they hit resistance at a resistance line, that's not a reason that you should think it's going to be short. That just means it's hitting a resistance line. It can pop back slightly and come through. But it's better than when it blows through like this one did and just blows right over it. And you see what I was talking about before? Blows over the line, tests it, and now that line becomes support. That means we're going higher. When the resistance line becomes support, going higher. Here, resistance line, not support, but then we blow through, boom. All right? Resistance, resistance, resistance. And when you're testing resistance a bunch of times, then you get over it, take it seriously. Especially the second time you go over, like that. Up, here we come 510. But my Nikkei is not doing that good, you bastards. Came in on either side. You got to be careful with the Nikkei because it moves each one of these is 5 points. You know, you're used to seeing like 1 point moves and things like that. These are 5 point moves every time. So they're more expensive than you think they are. All right, I got my sale in at 69, so now we can move back to talk about some other things, and then we'll see. I appreciate it when you guys tell me that something's going on in chat, but unfortunately, the problem with the system is I don't get back to the question fast enough. All right, so thanks, Rob, though. I appreciate it. Edith says you should keep an eye on you yesterday. Yes, thanks. There are 2 topics we were going to touch up on if you had a chance. Leap, mispricing, and doubling down or taking your loss. Well, we're talking about doubling down and taking losses now, right? Leap, mispricing. Well, you're going to see a lot of that. OIH, because we just did OIH in the butterfly portfolio. Oops. All right, see, people are curling over now. 16.5 is where I expected to see resistance on the Dow. So I'm going to take my $100 or my $50 and I'm going to run. So I no longer feel like I need this. There goes 1. And okay, so I'm off the Nikkei. I'm not worried about it blowing up and running away on me right this moment because I think that 16.5 is going to be a little bit of resistance here, and I think that 11.57.50 is going to be a bit of resistance. And I hope I'm right. That's all there is to it. Meanwhile, we'll see if this guy fills, and that'll be an alert. But, picked up $50, not terrible. Because, could have done better if I had caught it earlier for sure. Where are we? Oh, yeah, OIH, right. So most people just came out with the peak 2018 just came out.
Enough's enough. Decon bait.
Are you kidding?
The bait, then they die. Guaranteed. Decon.
How? This Yahoo is disgusting. Here, hopefully there's no ads on that one. All right. That's why I don't use them anymore because of these ads. It's just disgusting. All right, where are we? OIH, that's what we're going to do. So the 2018s just came out yesterday. Not on everything, but on some things. And that means they're very thinly traded. People haven't done them. If you want to get them, you really have to look at the ones that are even money. Because you're like, 20 or 25, you're very unlikely to get good pricing on the ones that are odd numbers because people just aren't trading them yet. Even if you put an offer in. So you see some weird numbers sometimes. I'm not particularly seeing here, but here's your bids and here's your ask. But if you look at this, for the 23, 24s, look how close they are. They're 40 cents apart. And because the spreads are so wide and they're 40 cents apart, it's possible that you could offer, let's say you want to be bullish. Look at some of these guys. Here, look at that. See 725 and 725? That's crazy. You're not going to get that most likely, but what it lets you see is that somebody is going too low on this one. So you can buy the 24s, and let's say that you could offer 50 cents between these, so 775 here, okay, for the 24s, and then you can offer for the 25s, so let's say 750, 775, and here you can offer 750, and then for 25 cents, you have a bull call spread. There's no margin on a bull call spread. So for 25 cents, you have a $1 bull call spread that's $5 in the money on an ETF. So it's much less likely to burn you because it's an ETF and it's already way down in the channels. So that's what I mean by mispricing. When you look at something, you say, geez, that seems like kind of low. So so sometimes you just put an offer in, and sometimes you get your offer because there's no set prices yet. There's very little transactions. Look, there's a transaction here for $450 and one here for $435 and one here for $194. Those are the only transactions. But look at these two. Somebody did it right here. The 30-31 spread, somebody picked this up for 15 cents on a $1 spread. So that's the kind of stuff you can look for on things just kind of any stocks you like that you like to play that you think are for sure going to go up. You want to go, you want to go for the sure things. It's so you say, well, for sure, I think this is worth more than that much, and then you look and find a good, you find a good price. They're hard to fill. They're going to take a while because people aren't trading them yet. People really don't tend to trade these very much until the 2016s disappear. That's when people start rolling to them. I like to get in early. I never understand why people don't, especially when the VIX is high and you're getting good prices. So here's Apple. Apple, compared to OIH, has a ton of interest, right? There's all kinds of sales on Apple. And that tightens them up. But even though it's tightened them up, you still get some crazy good prices. Like it's at 116 now, but you can buy the $85 calls for, well, there's only $1 spread between these guys, or $1.90. So you can buy these for like $40. In fact, the last person paid $39.80. You buy these guys for $40. So you say, well, now, okay, great. Let's say I'm willing to put in $10 into Apple, into an Apple spread. Well, you got those for 40. So who can we sell for 30? Well, you can sell him, you can sell him, you can sell him. You can all the way up to here, the 100s. And you can sell those 100s for $30.70. All right, so let's say it's 31. If you got 40 and 31, that's $9 on the 85-100 spread. So you're spending $9 for a $15 spread. that has $6 in profit if Apple stays over 100. So if you like Apple and you wanted to go up and you were going to buy the stock, you could buy the stock for $100, and let's say you spend $10,000 and you get 100 shares of Apple for $10,000. Okay, or you can get for $10,000 divided by $900 per spread, 11, or you can get 11 of the 85 100 bull call spreads. Was it 100? Yeah, it is 100. So you can get 11 of the 85 100 bull call spreads. So your 100 shares of Apple at 100 make nothing. You lose $16. Your 11 spreads at 100 make $6 times 1,100, $6,600. Okay, so to make $6,600 on the Apple stock, it has to go from where it is now, 116 if you bought it, and it has to go up $6.60. So it has to go to 121. Or 121.60 for that matter. I'm sorry, 122.60. So they look at it, and so what's the difference? There's a 20% difference. You make the same money, and you're laying out so much less. You're taking less risk. You have a built-in protection that it could drop 10% on you, and you're still in the money. You make your 100% money, even if Apple's 10% lower. You still make everything you wanted to make on the stock. And there's almost no downside to it. The only downside is if Apple goes higher than 126, you could have done better. But you have to lay out so much more money to buy the Apple stock. Am I doing the math right? Wait, if you have 11, you have 1,000. You have 11, you get 1,100 times 6 is 6,600, right? Oh, I see what the difference is. Silly me. Because if you bought $10,000 worth of Apple divided by 116, you get 86 shares. So let's say you had 100 shares up. So to make $6,000 on 100 shares, I know something's wrong with that. You have to make 60. I'm sorry, silly math. It's not 6. This is what my point was, which I kind of lost because I did the math wrong. It's not 6. Apple has to go from 115 to 175 for you to make the same $6,000. That's the point I was trying to make. I'm sorry, it's my mistake. So in other words, you take $10,000 and put it into Apple stock. And first of all, if it drops to 100, you lose 10% of your money. Second of all, to make $6,000, it has to go up $60. Okay? Whereas to make $6,000 in the spread, all you have to do is buy 10 contracts for $9,000. So you don't even have to spend as much money. You spend $9,000 on 9 contracts. You don't lose money unless it goes below 100. So you already have a 10% buffer. And you make all $6,000 if it's even a penny over 100. How would it even be a question to buy Apple stock? Why would you even consider owning the stock when you can do that instead? And now I'm going to add a layer of complication to it. Now, if you accept the concept that the bull call spread is better than the stock, but you are willing to own Apple stock, right? You said you were willing, you're comparing it to buying the stock, and you're going to buy it for 115 and hope it goes to 175 to make $6,000 lousy dollars. All right? So rather than doing that, how about you promise to buy Apple if it goes below 85? And for that promise to buy Apple, you're going to collect $9 for selling the puts. But wait a minute, the spread only costs $9, right? Now it gets even more interesting because now your $9,000 spread for 10 of the 10 of the 100 bull call spreads are $9. If you sell the $85 puts for $9, now you spent nothing. You have a promise to buy 1,000 shares of Apple at $85, so that's $8,500. No, I'm sorry, 10 is 1,000. Yeah. Wait a second. 85, 1,000. I'm sorry. My bad there. Okay, let's start that again. You spend $9,000 here on 10 contracts. Here you'd have to short 10 contracts. You would be promising to buy 1,000 shares of Apple for 10 contracts, not 100. There's the difference. You can shave any amount you want, though, off the $9,000 you spent, so you don't have to do the whole thing. But each time you sell one set of contracts for 100, so you originally wanted to buy 100. If you're willing to buy 100, then you shave 10% off your cost. If you're willing to buy 200 then for 85, which isn't a bad deal, then you would shave $1,800 off your cost, and that would increase how much you're laying out. The put, if you sell it, is a lot cheaper than owning the stock. And that's why we usually sell a lot of them, because we have, we're confident and we know we can roll it down the road. That's another thing. But if you sell 10 $85 puts, 10, 18, $85 puts, and we sell them for $9, is what Thinkorswim tells me. They're going to put $9,000 in our pocket. My max loss is $76,000 because I already got $9,000. They can assign it $85, and the buying power effect is just $6,000. $67.80. That's all the margin requirement for doing that. Because Apple is considered unlikely. It has only 0.21 delta. It's not considered a high-risk thing to be investing in and putting your money into. So you do have to realize that if you do promise to sell 10 puts, you are going to then be on the hook for owning $85,000 worth of Apple stock. So that's something you got to think carefully about whether or not you really want to do that. From the perspective of something like our long-term portfolio, though, we would. Now, the upside, though, is if you wipe out the cost of the spread, in whole or in part, though, but in whole, then you have a $15,000 upside at 100. So then your best case is you make $15,000 at 100. Your worst case is you own Apple for 85. And that's the way those spreads work. All right. Without even the question, I lost track. I should check the index because I keep doing this. Let's see what's going on here. Shorts. See, I never filled that. See, my bell never went off. And now we're back to 1965. Boring. Okay, but you can see why I got out of that Nikkei. It was just running. They all ran out of gas just after I got into that situation where I decided I should do something about it. All right, where are we? Okay, question. Keep an eye on yes. Leaps. Talk about mispricing. Doubling down, taking your losses. That's, look, doubling down. Wait, I just did that, though. We just did a whole thing on that yesterday, didn't we? This is very important. All right. I wrote a chart, in fact. I remember doing this. There, okay. So here's the conversation. Copy link. Go to this thing. Oh. Go to this thing, and I'm going to put it in here. Okay. So yesterday we were talking about this. So this is what it's not doubling down. It's very important you understand the concept. We're talking about scaling into a position. And the reason we're doubling down, which is a bad word, but we're doubling down because we knew we would double down when we started, and we took a small initial position. We wanted to double down when it went lower. In fact, we're practically disappointed if the stock that we get into here goes up and we never get a chance to own more than our initial shares. So, you have an allocation block. So if you have a $500,000 portfolio, you don't want to have more than 20 positions in a portfolio. I'm sorry, you don't want to have, you want to allocate 20. You want to break things up into 20 allocations. So that's about $25,000 per position. Now, you might have $1 million buying power, and depending on your level of comfort with the margin, you may say, okay, I can afford to do $50,000 per allocation block. But either way, your allocation should reflect 1/20th of your buying power, however you want to calculate your buying power. From that means that you say, okay, I have $50,000 to spend on something. Now, that means initially, in each position initially, you don't want to commit to more than about $14,000. You want to do about 1/4 of an allocation is roughly how you're going to start. You start off with a 1/4 position. If it goes badly, you'll consider going to 2 times. And if it goes even more badly, you go to 4 times. But when I say when it goes badly, it doesn't mean it goes badly because because China blew up and you had FXI and now you're hoping China comes back. No, China's not coming back. China's a goddamn mess. All right, so China's not coming back in the near future. You don't automatically double down. You have to look at the whole position from scratch and say, do I want to stick with this thing? So step number 1, and I went through all these steps one by one. I'm going to do it quicker here. If you want to do it, then read it in the chat. So step number 1, and we used ABX here as an example because it went very badly. So it's a good example of something went terribly wrong. But step number 1 for this particular position is you take 500 shares at 7. I think I said the allocation block was, if you want to own 2,000 shares. 2,000 shares at 14 is $28,000. So right about the allocation I'm talking about there. So if you had a $500,000 portfolio, this would be about where you'd want to start. And you say, okay, I would be willing to have 2,000 shares of ABX as my gold play. So you say 2,000 shares. That means you start by buying 500 shares. Because you know what? If ABX takes off, what are you going to do? First of all, you're going to make money. So shut up and enjoy it. All right? That's step number 1. Learn to enjoy making money. So if your quarter allocation goes up and you make money, fine, you make money. What do you do with the rest of the money? You look for another gold miner that didn't take off yet. And you see if that miner is worth investing in. And if not, you look at the other 50 miners in the sector and see if they didn't take off yet. Because if ABX is taking off, there's going to be a laggard, somebody who didn't take off yet, and it's going to move after them. Okay? Or if ABX happened to be the laggard and everybody else took off already, then you say, oh, I missed the bus on it. Okay, I'll just take the money I make on ABX and be happy. It doesn't matter. There's nothing bad about having money and making money and then saying, oh, I can't make more money on the same thing. I'll have to go find something else to do. So your downside to scaling in is 0. And everybody, it's woulda, shoulda, coulda money. Everybody panics over like what they didn't make. If they would have done this differently, or if they hadn't missed this or whatever. That's all garbage. Okay? There's always something to trade. Every day there's something to trade. Never hurts to be in cash. Never hurts to have cash. And it doesn't matter if one got away because there'll be another one tomorrow. Just learn to pay attention. Instead of worrying about what got away and what didn't get away, just worry about looking for the, say to yourself, well, next time that happens, I will know that there's a flaw. All right, but this one didn't get away. This one completely collapsed. But the point is, the minute you go into a trade, you should have your plan for what you're going to do when it drops 20%, 40%, and 60%. And if you don't have a plan that you're happy with for what you're going to do when your trade drops 50 to 60% on you, then you shouldn't be getting into a stock in the first place. There should never be a stock that you're buying other than a day trade sort of momentum gamble where you say, okay, I'm just buying it like the futures. Like, I'm buying it because I think it's going to go over this line. If it doesn't go over this line, I give up. Other than quickie trades. But if you think you're investing in something, and you have any concepts at all that you may want to down the road put more money into the trade, then you better damn well have a plan for what you're going to do and when you're going to do it and how you're going to do it. Because if you don't, you're just stumbling around blind. And that's essentially, for me, that's what a blog is. I mean, when I started first doing this, I started writing down my trading ideas and my plan for my trades so that I wouldn't forget what I was doing. And I would write to myself. I didn't care if anybody was reading it. I would write, okay, I'm buying ABX because I think this and I think that, and I'm buying this many shares, and if it goes this way, I'm going to do that. That was my plan. I would just write down my little plans. So now I write them down for you guys. It's the same thing. But here it is. So in this case, this is an example of somebody who said they did buy ABX, so that's why we went back and said it. But you buy 500 shares here. Now, obviously, you didn't say if it goes below 14, I'm going to get out, because you didn't. It goes down. These are days. Day. You know, many opportunities to get out. Now it goes down further. 13, nope, don't go out. 12, nope, don't go out. 11, now you're 20% off. You damn well better be examining. When you're down 20% on a position, you better be examining the position very carefully to determine whether you're in it. But the beauty of scaling in is because you're controlling your positions and because you're not overextending yourself on any single position, is that when you're dead wrong on an entry, when it goes from 14 to 11 on your 500 shares, you've only lost 4 times 500 is $2,000 on your $25,000 allocation. So going from 14 to 11, it's not 2,000, $1,500, sorry. Yeah, I don't know where that came from. So you're losing $1,500 out of your $25,000 allocation. 15, 25, what the heck? Yeah. 6%. You lost 6% of your allocation. And your allocation, we divide that by 20, 0.3% of your portfolio by making a mistake where your entry went wrong on you by 20%. So at this point, and that's another thing you have to train yourself to do, you have to understand this is nothing. It's nothing. It's inconsequential in my $500,000 portfolio. So at this point right now, you're not doubling down. You're deciding if you were wrong about your entry. You're saying ABX is down for the wrong reasons, and I'm going to ride it out. So it goes up, it comes back, it goes down, it comes back, it da-da-da-da-da, and here again. Again, now you're down 20% again. Each of these times, you should be making your decision again based on all this new information. December, March, June. Each time, new information. Why is this thing down? Is it down for good reasons or bad reasons? Now, if you think it's down for bad reasons, in fact, only if you think it's down for bad reasons, should you be sticking with it. Otherwise, take the damn money off the table and look how long you wasted. You wasted 6 months here staring at the damn thing, making no money. You would have been better off moving on 6 months ago, but now you're still in it, so you're still looking at it, and for whatever reason, you still like it. And in my case, I do still like it. I like it because I think gold is way too cheap. So this is my attitude about it. I want more ABX if it gets cheaper. And that's what the key is. Would you rather buy more ABX if it gets cheaper, or would you rather take your 0.3% loss and move on? So I'm saying I will buy more ABX if it gets cheaper. I'm not going to buy it here because what good does it do me to double down at 20% off? Then I'm 10% off. Who cares? If I wanted to save 10%, I should have sold puts in the first place instead of buying stock. So at this point, maybe I want to sell puts and sell calls and lower my basis and so on and so forth. But again, if we're just talking about very simply on the stock, I'm going to wait until I'm 40% down. And at 40% down, and I don't knee-jerk buy at 40% down, but at 40% down, you're going to make another decision. Why did we just drop 20%? You wanted it to drop 20% here. You planned on it happening. You said, well, maybe it'll go down 40% and then I want to buy more. You planned on it, but when it's actually happening, you damn well need to reevaluate where you are and what you're doing. But at 40% off, you make a decision. You say, okay, I'm going to buy. Now I'm going to double down. You double down here at 40% off. That's 8. 8 and 14 is 22, and now your average is 11. And this is just like that S&P I went into, right? If you get back to 11, you get right back to 500 shares. That was your goal, was to lower your basis. Your basis is 20% lower than you started. That's fantastic. All right, so if you do get back, that's great. Meanwhile, again, now how much have you spent? Now you spent $700 for 500 shares, and here you spent 7 times 5 is what? 42, 56, right? Yeah. So here you spent $5,600 for your next 500 shares. Or I'm sorry, 500, 4,000. What are you talking about? I'm talking about, I'm looking at the average, I'm sorry. It's obviously 500 times 8 is 4,000. You're spending 4,000 next. So how much have you spent? You spent $11,000 at this point. 4,000 shares. Yeah, $11 a share. So now you're in for $11,000, and don't forget you're down because you're here at 8 and your average is 11. So you're down the same $3,000. It doesn't magically disappear. Now you're down $3,000. You have twice as much ADX. At this point, I would really be selling calls and covering to lower my basis. I wouldn't just be buying more stock. But nonetheless, even at this point, though, you still have, out of a $25,000 allocation block, you haven't even used $14,000 of it. And $14,000 buys you a lot of stock at this price. Now you're still saying, though, you know what, if this guy drops another 20%, then I'll buy 2 more, because another 20% takes you down to like 6.5, takes you down to 5. So if you put 1,000 more at 5, that's $5,000. Then you would have spent $16,000, but you have 2,000 shares of ADX at net 8. And again, I would have sold calls. I would not let it just go like that. But even so, you see how powerful this is? Because now you're at net 8. And all you need is a little bounce back to $8, and you can get back to 500 at $8. And then you've got a really cheap entry that you can just leave it alone and see what happens over time. But only if you absolutely want to have this much stock and you planned on it, should you be doubling down. You don't just double down because you're down, and you don't just double down to save yourself 10%, because you're not saving anything. You still have the same loss, you're just spreading it out over more shares. And now on the next leg down, your loss is double. But when this is, oh, you hear that sound? That was the S&P filling. In fact, speaking of doubling down. So here we are getting close to my goal of where I do want to double down. You see how I was patient and I waited and I'm being, quote, quote, rewarded. I'm down $800, but I'm being rewarded for my patience because I'm bringing my basis up. So, and we tested, we just about tested up here. I still want to, so I'm not, because we touched 1970, I'm not too eager to get another one here. I'm at 1963 on the average. And I'm calculating, what if I get another one at 1969? That's 6 higher than 1963. That brings my average up to 1965. I can accept that. So I don't mind that. I'll actually do that. So let's get another at 1969. So in other words, $6 more divided by 3 that I already have is going to add 2 to each one. And that'll put my average down to 1965. So I am willing to go one more at 1969. But also now, because my average is 1963, then I want to go down here, and I want to say I will sell. I will buy and close one at 1963. So either way, a bell is going to ring in one direction or the other, and then I'm going to change my positions. I'm going to go back and see where I am. But my goal is to get out. And by the way, I'm doing this. I don't mind being short tomorrow into the Fed. I think there'll be a sell-off either before or after the Fed, maybe overnight. So I don't mind being short a few S&Ps. And like you can see, it's only $700. It's not like a huge deal. Well, not the way I trade. So now I'm just waiting to see what happens. Only 2 possible things can happen. Either my position reduces and I have a nice low basis and I would cancel this order to sell, or I get my fill, and then I'm going to raise my stop to get out at 1965. So one of those 2 things will happen at some point. All right. So scaling. All right, hopefully that's clear, and then you're averaging in. And I wrote all about it and all the variations, and I even have the example of the trade. I mean, look, we went into quite a lot of detail here. So if you want it, follow the link. All right, back. Okay. I mean, holy crap, it's 2:15 already. These things fly. All right. Butterfly calls. Should you sell more strangle to go long? I'm not sure where that one came from. You're still asking about Walmart. Well, like I said, 10 is fine. I'm comfortable with 10 for now. We'll see how it goes. That's all. Keep an eye on the yes. Talking about the leads. S&P. Craig says Apple's back to 116. Seems to be ready to unleash another great quarter. Are you ready to buy it again? No, I'm not. Not until I see what happens with the Fed. I still want to see if the markets go up, if the markets go down, what happens, so on and so forth. The price of Nikkei futures doubled to 88 fast last month. What would make it drop back to where it was? What makes these changes? What will drop it? The Nikkei, the Nikkei has the overriding fundamental of Japan being in big trouble. They've got an aging population. Things are slowing down. They're massively, massively in debt. They're using 1/3 of all the incoming tax dollars just to pay the interest on the debt they already have, and they're borrowing more money every day. Country's a disaster. Okay, it's just running along by people ignoring the fact that they're a disaster. That's not a premise in which I want to go bullish, although they are moving up. I could have kept those Nikkei longs, but I didn't. But they are still moving up a little bit. But they'll bounce around. I mean, they're not going to go fall to their doom unless their debt becomes a big issue. Then they can fall to their doom. Let's see. Can the number of characters in this chat be increased for my longer questions? No, thank goodness. How did you set up the resistance lines on the charts? I did not set them up. Those are standard resistance lines in Thinkorswim. We talked about them last week, and you can replay that. They're called pivot points. It's a study in Thinkorswim. Brian says, does your premise still stand for the morning trade when it was reverse split and there was 8x less shares? The premise still stands for more. Wait. They did reverse split. That's done and gone. That's an over thing. This is now where they are. And yes, we still like them. That reverse split happened back in August 3rd or something like that. And today, they are 1973 at the moment. They were down for a bit, now they're back up. But they're just around. I think this is basically they're bottoming out here, hopefully. What's your thought on a BlackBerry turnaround? I don't think anything of a BlackBerry turnaround. That is BlackBerry, isn't it? Am I wrong? It used to be, the last time I traded them, they were RIM. I haven't cared about them since. Or is it Burberry? Maybe it's Burberry. Nope, BlackBerry. See, Burberry, I like the raincoat. It's different. Look, how many telephone companies do you invest in? Because to me, I mean, it's just one of many companies that makes phones, and all of them seem to be losing money except Apple. So what is the turnaround for a phone company? They'll sell a lot of phones and lose money like everybody else is, like Nokia and everybody else. It's not a profitable venture. Apple really makes money selling apps. They don't make money running phones. Google does. So with Apple, they control the operating system. They're selling you music on iTunes. It's like Amazon, like what Amazon does. Amazon gives away a Kindle because they make money on all the crap that they sell you on the Kindle. Apple essentially is doing that. They're not though, because Apple actually makes money on the phones. But the real money for Apple is in all the apps and the software and the songs and the tunes and this and that. And now they're doing the streaming thing with the Apple that my daughter. I frankly haven't tried it. I signed up for, which one was it? Spotify. I like Spotify, but I put in all these things and I had a trial. But during the trial, I used it once. And then the trial ended, and then they wanted me to put in all my things again. I was like, oh, screw you. I'm like, how dare you? So I honestly, the only time I end up listening to a lot of music is if we're in the backyard or something like that, or if I'm on a trip. When I'm on a plane, I like to listen to music on a plane or when I'm traveling. But most of the time, otherwise, I'm just busy. I don't have, unfortunately, time to sit around and listen to music like I used to. But anyway, but a BlackBerry, that's not what a BlackBerry is about anyway. BlackBerry is about being a phone. And they don't have the compelling advantage. They never used to be special other than they had a little bit better security and encryption than other phones. They certainly can't be offering that if they're running a phone on Android. There's nothing special about them. It's just a phone. It's a piece of hardware, and they've got no control of the operating system. They're not making money on the songs. They're not making money on the apps. They're just selling a bit of hardware that other people make money on. So it's not for me. All right, and Craig says, I'm asking about the price of a futures contract. What? Oh, the price of Nikkei futures doubled to 8,800 last month. Oh, that's due to volatility. Yeah, they raise the prices. Something's too volatile. They ratchet up the price of the futures. I don't notice it 5 times the margin, but yeah, that's all that is. There's nothing exciting about that. So yeah, basically, I mean, it does mean, though, obviously, that you don't want to trade a lot of Nikkei contracts, so you run out of margin pretty quickly. It's due to the volatility. It's an insanely volatile position, the Nikkei. Where is it? Oh, here it is. So, you look at this thing over days. That's nuts. Of course, it's got to have a high margin hold when it can go down like 2,500 points in a couple of days. And here, this isn't that far ago. Here it is going up 2,000 points, and here it is going down 2,500 points, and here's 1,000 or so, and there's 1,000 points, and there's 500 points, and there's 500 points. Here's 1,000, here's 1,000, here's 1,000. Ew! It is volatile. That's why it's volatile. If it ever stops being volatile, they'll hold less money. Now, the S&P isn't that much better. All right, because don't forget this move of 100 points. Well, it is different because this move here, 100 to 1,900, is 200 points. It's 20 per contract, so that's a $4,000 move. So even a big move on the S&P, $4,000, $5,000 if you count top to bottom. That only happened one time here, $5,000. With the Nikkei, every 1,000 points you see is $5,000. That's $5,000. That's $5,000. So it's more. And also, if they raise the price of the S&P contracts as much as they raise the Nikkei, people would have a complete hemorrhage, the future traders. So, nobody really cares what they charge for the Nikkei. So they kind of want to discourage people from just wandering into this contract. It is much more volatile than you would think an index would be. Now, if they calm down over time and they go back to, back to this, which was from 2009 to 2012, or even this isn't considered volatile because it goes up in a fairly straight line. This is down in a fairly orderly fashion, except for that. But everybody crashed there. But, this is fine. This is not fine. This kind of move is not fine. And that's immediately what they're going to do is reprice the futures and try to get people to stop playing. And so look, the bottom line is if you're trading and the futures contracts have a lot of margin, probably means you shouldn't trade it. Unless you really are comfortable with trading that contract, a lot of margin means it's not something most people should be messing around with. They don't arbitrarily do these things. It's based on mathematical models and say this thing is ridiculously volatile. So speaking of which, how am I doing on my S&P trade? 1960. See, unfortunately, had I gotten my average up to 1965, we'd be out of here now. We had 1966. I'm going to take that off for now because, frankly, if it goes back to 1969 now, I don't know if I want it because now that would be kind of dangerous. It would be a big turnaround. But hopefully I'm going to get my fill on the low side. Now, what else do I want to talk about? Oh, also Monday. What did we talk about that's very important? China. This is important. In case you haven't seen these, we were talking about this in chat yesterday. These are the refugees. Not all of them. This is just one boat. These are the refugees. And there's many, many more. These are just the ones sitting on the dock waiting for the next boat. These are the boats. They pay whatever they got, and they all jam onto this boat in these incredibly horrible conditions. And they are running from their country. And they are climbing the ropes, and they are climbing up here, and they are doing anything they can to get on this boat and get the hell out of their stupid country. And they're heading off to Europe with no papers, no documentation, because you can't go to Syria's passport office and ask for your passport. It doesn't work that way. You just have to leave. It's a very tricky situation, and it's going to put a lot of pressure politically and economically on Europe, and it's not necessarily a good thing. There's going to be upheavals. There'll be arguments back and forth. There'll be all sorts of things going on in Europe. So again, these are just headwinds that you have to watch out for in the economy. Everything is not coming up roses. Germany's economic survey today was down 50% from last month. That's not good. Oh, here's Spain. These are all people. People, more people over there, people over here. Okay, this is a rally for independence from Spain, of the Catalan province, which is, I think, is like a quarter of Spain's economy. They want to leave and split Spain into two different countries. And again, economic upheaval, uncertainty, danger, all these things are playing out. And Greece, by the way, there's articles saying they're saying Greece has to have a bailout. There's no other possible solution, but Greece has to have a bailout. That's all going to hit the fan again in the spring. There's a lot of uncertainty out there. Okay, we don't lightly say go to cash. There's just too many things going on that could cause a major problem that we're not comfortable following this stuff right now. We're talking about petroleum consumption, but that wasn't. Let's look at China. Here it is. Okay. We're talking about Cliffs, and I like them because they're not in China. They're in America. They're a U.S. company. They've gotten out of Asia completely. It was a painful divestiture of their bad assets in Asia, but you can't compete selling iron ore in Asia. They're just willing to sell it too cheap, and the state companies don't mind if they take a loss as long as they beat the competition. So I started talking about China, and the thing I wanted to point out about China is why do I like Cliffs? I like Cliffs because iron ore is stupidly low. And why is iron ore stupidly low? Iron ore is stupidly low because China, all during this time, first of all, it was stupidly high. Now it's stupidly low. It'll get stupidly in the middle at some point. And in the middle could be 80, could be 100, whatever. But I'm not saying it's going to go anywhere near back to there. But it's going to be higher than 40. And Cliffs makes money higher than 40. They make money at 60. They make money at 80. They just don't make any money down here. The problem is, the reason iron ore spiked up to 200, 180, whatever, was because China was ordering twice as much as they actually needed. And this is true of many, many raw materials. They're ordering ridiculous amounts of them. And they stockpile them. So they were ordering them, and they say, well, we're going to keep, they've got these 5-year plans. And they say, well, for the next 5 years, we're going to build this, and we're going to build that, and we're going to build this, and we're going to need all this material. So let's order it all now and make sure it's here so we don't ever run out and have work stoppages and things because we run out of stuff. They like to have warehouses and things packed up with stuff before they get started on their projects. That's a terrible thing, obviously. It's completely against all the concept of just-in-time manufacturing that we've developed has been efficient for the last 30 years. They throw it out the window and go back to, the very, very old days when you would, pile up all your stuff before you make something. So they have all this stuff sitting in warehouses, and then things slow down. The stuff in the warehouses is pledged as assets to the banks who loan the money for the project. So when the projects fall through, the banks take the iron ore from the warehouse, and they say, well, what's the bank going to do with it? They're not going to build a building. They're not going to build a railroad. The bank is going to sell it for whatever the hell the going market price is. They don't care if they make money, lose money. It's better than the zero they're getting for the loan. So everybody is liquidating commodities in China and selling them wherever they can. Look at these consumption numbers. Consumption is a percentage of world demand in China. From 2000 to 2010, aluminum, copper, lead, nickel, doesn't matter what it was, they bought more and more and more and more and more. Double pretty much everything. They did not need double. And here's and further down I have a proof that they don't need double. We'll get to that in a minute. At this point, they consume 50% of the world's cement. 50% of the iron ore, 50% of the coal, 50% of the pigs. Jeez, that's a lot of pigs. I mentioned that. I went to a dim sum actually a few weeks ago, and I was like, damn, they eat a lot of pork. Dim sums where they pass around all these different trays of stuff, and you just eat random things constantly. And I could not believe how many things had pork in it. It was like almost half the stuff we were eating had pork. Steel, lead, zinc, aluminum. There's only 1 billion of them. There's 1.4 billion. There's 1.4 billion Chinese people. There's 7 billion people on the planet, yet they're consuming half of all these resources? That doesn't make sense. And as I said before, when something doesn't make sense, think about how you can bet against that. Think about how it's going to change and come back. Okay? They eat a lot of eggs, apparently. A lot of eggs. Way more eggs than other people want to eat. And that's interesting to me, because I don't, other than egg foo young, I'm not really, I guess it's for breakfast or something, or what? I'm not sure what they do with all those eggs. 28% of the rice, they eat twice as much rice. So, again, they've got 1,400 out of 7. They've got 20% of the world's population, and they're eating 28% of the rice. Okay, so they like rice a bit more. They like rice 40% more than most people. That's fine. I can understand that. Obviously, they do. That anyone who's eating Chinese food knows they like rice. Eggs, they really like eggs. Soybeans, they like soybeans 10% more than most people. Well, that's fine. Wheat, they're not big on wheat compared to most people. Chickens, they eat less chicken than we do. Okay, oil, they consume a lot less oil than everybody else does. That's one thing that can still grow because they're consuming half the oil the rest of the world does. Cattle, they don't eat beef yet. All right, and their GDP is 10% of the world, and even though they have 20% of the people, so that may change over time too. Now, you compare this to America. They eat almost as much cattle as we do, but we have a lot less people, obviously. We use twice as much oil as they do. Our GDP is much higher than theirs on a parity basis. Wheat, it's weird because we grow the wheat, but they eat it. You know, we send it all to them. It says right there, they got 19.7% of the population. We have 4.5% of the population. It gives you an idea how stuff looks. See, we hardly, even though we have Chinese restaurants, we don't eat much rice. So this shows you how it breaks down. This was in 2010. This is what they believed would be the trends for China. Here's the trend everybody thought was going to happen. Here's the trend. I don't even know if we're on this trend, but here's the trend we're kind of on now. Low GDP growth, low commodity intensity. We are way off this track. But our producers of commodities were planning on this, and they all got caught with their pants down because they were producing on this level. And if you look at the reality of it, in 2010, China was consuming this, or in 2000 they were consuming this, and here in 2013, 13 years later, they're consuming that. In reality, though, look at the rice. Rice, flat down. Poultry, flat across. Beef, not so much up. Oil is a great indicator of industrial production and everything else, so oil didn't even double. If oil didn't double, why is lead up 4 times? Why is copper up 4 times? Why is aluminum up 4 times? These things should be double, not 4 times. And the reason they're up 4 times instead of double is because China is stockpiling stuff they don't need. And they've been doing it for years. And because they have these gigantic stockpiles and they slow down, it's going to take years for those stockpiles to unwind. And it's going to take years for commodities to normalize. But that doesn't mean commodities are bad bets. It means that in the grand scheme of things, as you look back 20 years from now at the great commodity glut of the early 21st century, they'll say, oh, well, China at first created a huge demand by buying up commodities, and then they stopped buying them, and all of a sudden everything collapsed and the prices collapsed, but then things went back to normal. And you see these kind of charts all the time. They go up, they go down, then they go back to normal, and they drift around. So I don't mind buying companies like Freeport-McMoRan, like ABX, a gold company, like whoever the heck we were just talking about, Cleveland-Cliffs. I don't mind buying companies that I think are going to survive long enough to get back into the good old days, into the better days of commodities. They're never going to be what they were, but over time they could be incredibly good investments as the cycles normalize. But that over time is 2 years, 3 years, 5 years. This is for long-term investors. And also, you don't want to put all your eggs in any basket because any one of them could go bankrupt. I mean, it's tough getting through this sort of torture. But so far, everybody's holding on, everybody's riding it out, and people, all these companies have ridden out bad times before. This isn't particularly worse, but the problem is some of them got caught with their, caught really in the wrong direction because they were ramping up right at the time that oil prices collapsed. And that goes for the oil companies too. There's a lot of that going around. And there will be some bankruptcies and people will go out of business. You don't know who. But just like in the financial crisis, right? If you bought every bank in the financial crisis, you would have made a fortune because they were all trading as if they were going to be bankrupt, and only a couple of them actually went bankrupt. You have to diversify, and you have to accept that you're going to lose some money on some of them because some will go bankrupt. So you don't go, you must, if you're going to play these kind of plays, you have to play them, spread out your risk, keep an eye on stuff, don't be too much in any sector, and obviously even so, this entire play of I don't think commodities are going to go down forever, that's a concept, that whole concept needs to be no more than 20% of your portfolio, because maybe they will. Who knows? Not likely, but anything could happen. You never don't bet not likely your whole portfolio bet. That's never a good plan. So that's my very important point about China. We are in an abnormal situation. That abnormal situation will continue until China is fixed and Greece is fixed and Spain stops having these separatist conversations, and until Germans get confident again and start producing stuff, until our manufacturing numbers were dreadful today. I think our capacity utilization, if I remember the number correctly, well, hang on, this is what Google is for. Industrial production. News on industrial production. There you go. I'm blaming the auto sector. There's an advertisement somewhere. Come on, go away. Seriously? All right. Oh, there it is. 77.6%. So we're not using 23% of our capacity. Idle. That's horrible. That's a horrible, horrible number. All right, and it's continuing to drop. It's worse than it was last month by another percent, and it's continuing to drop. We are shutting down our factories. How is that going to be bullish? We basically have, as little manufacturing as we have left in this country, it's still too much to meet the demand. And we are idling capacity. And by the way, when you idle capacity, it's not like you flip a switch and put it back on. So when you idle capacity, you're talking about long-term layoffs. You shut down a plant, you mothball your equipment. It can take 3 months to restart. Plus you end up letting employees go, then it takes time to bring them all back and get things going again, and so on and so forth. Nobody shuts down a plant on a whim. So when you see these kind of numbers, this is their long-range expectation for the economy is not good. They continue to shut things down. It's the press just cheerleads stuff and tells you how great everything is and how you should invest and so on and so forth. And I mean, look at the Dow. It's up 1.5% right now. So you get a number that says capacity utilization is down 1%, but the Dow Jones Industrial Average jumps up 1.5% in a day. And it's because it has nothing to do, our economy has nothing to do with actually making stuff. It's only about whether or not these companies are going to keep getting free money from the Fed. And if they're going to keep getting free money from the Fed, then everybody's happy. And that's really sad, okay? It's not the way to run an economy. It's not an economy I like to really invest in heavily. So I'm still very cautious. And again, also, it's not helping. I hate to do anything with Yahoo, but let's do it again. CLF. still down for the day. Why would it? It's not helping the commodity companies. So if the Dow Jones Industrial Average is jumping up, how about U.S. Steel? And the companies that make things that the industrial companies are supposed to use go down, how does that make any sense? What are they manufacturing? And the answer is they're not manufacturing anything. The Dow Jones Industrial Average is a joke. It's just 30 companies, and most of them aren't even industrial anymore. They're like, tech or whatever. Apple, of course, is in it. Apple's up today. It's not a reflection of what's actually going on in the economy. It's a reflection of what's going on with the Fed, with the money that's floating around, with companies' ability to borrow cheaply and do something with the cash, the ability to shuffle money from one place to another. That's what this is all about. It's not about whether or not this economy is improving. If the economy is not actually improving, then long term it's going to show up. And it's going to show up as the prices fall and problems start becoming more apparent. All right, so anyway, so that's my warning. I wish I had better news, but I don't. We got, as I said, we went over the butterfly portfolio. We looked at that, right? We looked at a couple of those positions. We looked at we didn't look at the 5% portfolio. Let's see a quick look at that. I reviewed that earlier. There it is. And we looked at bid. It's Sotheby's. We're waiting for our premise on Sotheby's, and they're still cheap. In fact, they're cheaper than where we bought them. But our premise on Sotheby's is that they moved the major auction from Q2 to Q3. That led to a big disappointment in the earnings that they just reported. Where is this chart? Ugh. All right, look at that. Bid. Here we go. So, huge disappointment on their quarterly earnings in July, but the reason is that they moved an auction that was going to be done, that was going to come in June, was moved to July, so it didn't show up in the report that they put out in July, and boom, down it goes. So they missed their earnings because their earnings aren't going to show up until this auction is reported in September. So not September, but in October when they do their next earnings. The auction was a huge success. It set a record. They moved it because some companies care about actually running a company, and Sotheby's made the decision that the June timing wasn't going to be good because it was competing with some other auctions, and people get exhausted from going to auctions and writing $1 million checks. So they decided that if they move it back a few weeks, they would have a better auction, and plus there were some items that they wanted to include they wouldn't be able to include if they ran the auction in June. So they said, you know what, we can include more stuff and we can get this and that, and the sellers and the buyers will have a rest and they'll be more excited to buy when they come back. They will write about everything. It all worked out perfectly. They ran their business perfectly. The market doesn't care if you run your business perfectly. The market only cares about how your quarterly numbers look. So that's why we like Sotheby's. I think it's still ridiculous how low they are right now. This is a fantastic entry on this company. And it's funny because they're an auction company. They don't have they make so much money. They just make commission on everything they sell. It's not like they're buying the stuff in its warehouse. They just make this money. What happened? Oh, the Dow, we have this bullish one, which is actually doing nicely now because it's bullish. We have a bullish play on gold that's not doing so well, but it still have hope for that. Where's gold now? 1103. RJET is still having a union talk. So they're not going anywhere right now, but it's a February play, so I'm not worried. iRobot's doing well already. Cameco, did we say to kill it? What do we decide? I dumped them, but they still look like they want to pop 14. That's what. Oh, and see, here they are. They're just trying to get over 14. Let's see. Oh, that's a good idea. Let's see if they made it because of this little rally. Let's see if that helped. Nope, but they're still trying. They're still up. Now, the problem with Cameco is that they are restarting nuclear plants around the world, but it's taking longer than we thought, and it's slow going, and there's been a couple of hitches in getting things started. So I'm not really enthusiastic about that one. I almost feel like cutting and running on that, but not yet. And then Taser has already taken off. Oh no, I'm sorry, Taser. This is a funny one. Taser. That's why I want to talk about this in the first place. You see these numbers: down 4,000, up 2,000, up 300. So up 23 and down 41 is up. It's down 18. Is it? Is that right? Down about $1,800. But the thing about Taser is, let's show the chart. What do we have in Taser? We have the 20-25 spread. And where is Taser? You would think Taser must be doing terribly for us to be down $1,800. TASR. No, it's at $24. We only wanted to go to 25, and it's at 24. Yet that trade is showing a loss. It's really insane. It's showing a loss because the premium that we sold on it, sorry, there it is, because we sold 2 sets of premium. We sold 30 options worth of premium, and we only own 20 options. The premium has gone up, and it's giving us a worse-looking price. The $15 puts, Taser's at 24, and the $15 puts is still $2. That's crazy. Think about it. It's got to drop $10. It's 40%. This is 40% below the current price, and it's $2. These $25 calls that we're short are showing that we lost. They went up $2, but the $20 calls that we're long on only went up $1. And that's where the loss is coming from. 20 times a dollar is $2,000 of loss. Because these have more premium than these do. Can we lose that money? No, we can't possibly lose that money. Because we get the net of 20 to 25. If it's at $1 million, it still gets $5 for us. Anything over 25, we get $5. We get 5 more than they do. That's the bottom line. We will always get 5 more than they do. So this trade is stupidly priced. This is what you call a mispriced option set. And I would absolutely, as a brand new trade, still do this trade. It's fantastic. I'm pretty sure I said that down here. Yeah. This trade will make, it's currently zero. It costs like net zero to get into the trade. It'll make $10,000 at its full potential. And that's that's $20 a day. This trade will make $20 a day, or $600 a month until 2017 in January if it stays on track. And yet here it is, you can buy it for a net price of, you get 14.4, less 12.4, less 2,000, it's net zero. It's actually a small net credit on this position. So that would be for this particular webinar, let's end it on that. That's a fantastic trade. That is a totally fantastic trade. It's incredibly stupidly priced, and I highly recommend it. That's my favorite today. All right, so let's call this thing to a hold. I'll just see if anybody had any last questions. What happened to RIG? What did happen to RIG? I'm asking about the price of futures. Oh, we did that. What happened to RIG, he says? Did they go up or did they go down? RIG is also caught in that commodity trap. Probably went up. Nope, they went up. Look at that. That's silly. I have no idea why they went up 5%, but again, this is one of the ones that we like no matter what. They're stupidly priced down here. That's why we're still long on them. They're stupidly priced. But because of oil being what it is, I guess oil popped up a little bit today. That probably helped them. But because they're stupidly priced, because oil is so ridiculously low also, there's not that onus it'll come back. Whereas Cleveland-Cliff, on the other hand, or Taser, on the other hand, or Walmart, I feel they're at really good bottoms that are investable. RIG may go lower I would like it more if it went lower, and frankly, back here at 11, I would make a play on it. Now it's at 15 already, or even this morning it was at 14. I just missed it. If you miss it, you miss it. You know, if I was going to pick it, I'd pick it next time it falls if it does. But meanwhile, we do have a long position on the Transocean. All right. Well, that's that was a really fast 2 hours. Holy cow. That really? Wow, look at the time. Okay, definitely have to go. Thanks, guys, and we'll pick it back up again next week, and I'll see you back in the chat room, all right? Take care, everybody.